90 minutes. That is all it took. Not for headlines to circulate, not for markets to open, but for the balance of power in one of the most energy-critical regions on Earth to be tested. Missiles in the sky, airspace shutting down, oil climbing before traders could even log in. This was not just retaliation, it was a stress test of supply chains, of defense credibility, of global liquidity. And while most of the world was asleep, a question moved from theory to reality. What happens to business when geopolitics rewrites the risk model overnight? And what if the real shock hasn't even begun? Welcome to Boring Currency Ledger, where numbers speak louder than noise. If you've been navigating markets longer than most social media analysts have been alive, consider subscribing. Think of it as adding one more reliable instrument to your decision-making toolkit. And before we begin, tell us, which city, which country are you watching from today? In the early hours of the escalation, most global markets were closed. Screens were dark. Traders were offline. Executives were at home. It was a weekend window, the kind of window when governments act because price discovery is temporarily silent. Within 90 minutes of the first American strikes, Iran responded, not with statements, not with warnings, but with coordinated action across multiple countries. Missiles were launched toward U.S. facilities in Bahrain, Qatar, the United Arab Emirates, Kuwait, and Jordan. Drones moved toward Israel. This was not a single-target retaliation. It was simultaneous pressure applied across the region's military infrastructure. For business leaders, the key detail was not the number of missiles. It was the structure of the response. Simultaneity requires preparation. Military analysts observe that such coordination suggests pre-positioned assets and delegated authority. In simple terms, decision chains had already been shortened. Launch systems were not waiting for last-minute approval. Plans had been rehearsed. That matters economically. Because when preparation replaces improvisation, escalation risk increases. It means both sides had already moved beyond symbolic gestures. They were operating from structured contingency planning. One of the most strategically significant reports involved damage to infrastructure connected to the U.S. Fifth Fleet headquarters in Bahrain. Even without confirmed casualties, infrastructure targeting sends a clear signal. It targets command capacity, not individuals. It targets systems. Infrastructure is the backbone of operations, military and economic. The Persian Gulf is not just a military theater. It is one of the world's most critical energy corridors. Naval command centers in this region support maritime security for oil shipments, container traffic, and global trade routes. When infrastructure in such a corridor is struck, markets interpret it as a stress signal. At the same time, regional missile defense systems were activated. Interceptions were reported in several locations. Some projectiles were neutralized. Others reportedly reached near target zones before being stopped. Defense systems were tested in real time. For decades, billions of dollars have been invested in layered missile defense across the Gulf. These systems are designed to project deterrence. Their credibility influences geopolitical stability. The important question for investors is not whether every missile was intercepted. No system guarantees perfection. The question is whether markets perceive strength or vulnerability. Perception drives capital flow. And while military exchanges unfolded, Gulf states began closing their airspace. Civil aviation was rerouted. Commercial flights were diverted. International carriers suspended operations in parts of the region. Airspace closures are not symbolic acts. They immediately disrupt logistics networks. The Gulf region serves as a major transit hub between Europe and Asia. When planes are diverted, supply chains adjust. When supply chains adjust, costs rise. The first economic shock in a regional conflict often appears in transportation. Executives in shipping, aviation, and insurance sectors understand this well. War risk insurance premiums can shift within hours. Freight contracts can be repriced. Risk models can be rewritten before equity markets even open. Meanwhile, oil futures began reacting in electronic trading sessions. Prices moved sharply upward. Traders were not pricing confirmed damage. They were pricing probability. Probability of prolonged conflict. Probability of maritime disruption. Probability of escalation into energy infrastructure. Energy markets operate on expectation. If there is even a small chance that a major transit choke point could be threatened, futures markets adjust immediately. For entrepreneurs and business owners, this is where the story becomes practical. Energy is an input cost across almost every industry. Manufacturing, transportation, agriculture, logistics, all depend on stable fuel prices. A sudden rise in oil does not remain isolated in commodity charts. It travels through the economy. Higher fuel costs raise shipping expenses. Shipping expenses raise product costs. Product costs influence inflation data. Central banks, already navigating inflation concerns, must then factor geopolitical instability into policy decisions. This is how a 90-minute military response becomes a macroeconomic variable. Another critical factor was timing. The escalation occurred while global equity markets were closed. This created a gap between event and reaction. When markets reopen after a geopolitical shock, volatility tends to cluster. Algorithms respond to headlines, investors reposition, liquidity can thin. For serious decision makers, the lesson is clear. Geopolitical events no longer unfold slowly, they move at operational speed. Retaliation cycles are measured in minutes, not weeks. The first 90 minutes demonstrated something larger than military capability. They demonstrated readiness, they demonstrated coordination, and they exposed how tightly connected global trade, defense systems, and capital markets truly are. This was not yet a full-scale regional war, but it was a systems test, a test of defense credibility, a test of energy corridor stability, a test of investor confidence. And in global markets, confidence is a form of currency. When confidence is tested, capital hesitates. And when capital hesitates, growth slows. For business leaders watching carefully, the lesson from those 90 minutes was not about missiles. It was about structure. Structure determines duration. Duration determines economic impact. The first phase had begun. The deeper question was no longer whether retaliation would occur. It was how long the system could absorb it before pricing in something far larger. Energy markets and the Strait variable. When missiles fly in the Gulf, oil does not wait for confirmation. It reacts to probability. Within hours of the first confirmed strikes, crude prices surged more than 7% in electronic trading. Brent moved toward the $90–$100 range before many institutional desks had fully assessed the situation. This was not panic. It was risk repricing. Roughly 20% of the world's daily oil consumption passes through a single narrow waterway, the Strait of Hormuz. On average, between 17 and 20 million barrels of crude oil and condensate transit that corridor every day. In addition, a significant share of global liquefied natural gas exports also move through the same passage. At its narrowest navigable point, the strait is approximately 21 miles wide. Shipping lanes within it are even tighter. This makes it one of the most important economic choke points in modern history. When escalation occurs in this region, traders do not wait for closure announcements. They model disruption probabilities. Even a 5% perceived risk of obstruction can trigger price adjustments across futures curves. The mathematics are simple. If global oil supply tightens by even 1 to 2 million barrels per day due to precautionary rerouting or insurance delays, spare capacity elsewhere must compensate. That spare capacity is limited. OPEC producers maintain buffer capacity, but activation is neither instant nor politically neutral. Higher oil prices transmit through the global economy quickly. For every sustained $10 increase in crude prices, transportation costs rise measurably. Airlines face higher jet fuel expenses. Shipping lines pay more for bunker fuel. Trucking margins compress. Energy is not just a commodity. It is a cost multiplier. In many economies, fuel costs directly influence food prices. Agricultural machinery runs on diesel. Fertilizers rely on energy-intensive production processes. Refrigerated supply chains, some consume electricity generated partly from fossil fuels. An energy spike is therefore an inflation accelerant. Central banks are sensitive to this transmission mechanism. If oil approaches or exceeds $100 per barrel for a sustained period, inflation expectations can re-anchor upward. Bond markets then adjust yields. Higher yields raise borrowing costs. This is where geopolitical escalation intersects with monetary policy. Business leaders must understand that higher energy prices do not remain confined to commodity charts. They affect interest rates, currency stability, and consumer spending patterns. Shipping insurance markets also react quickly. War risk premiums for vessels. Transiting high-tension zones can multiply several times over within days. A tanker previously paying standard insurance rates may suddenly face surcharges that add hundreds of thousands of dollars per voyage. Those costs are passed down the chain. Import-dependent economies feel this first. Countries in Asia and Europe that rely heavily on Gulf crude face higher import bills. Their currencies can weaken if energy payments rise sharply relative to exports. Currency depreciation then increases domestic inflation pressure. The Strait of Hormuz therefore functions as more than a geographic passage. It acts as a leverage point within the global financial system. Even without physical closure, the mere threat of disruption increases volatility. Historical data supports this pattern. During previous Gulf tensions, oil price spikes often occurred before actual supply reductions materialized. Markets move on anticipation. In the present case, analysts also monitor maritime traffic data. Satellite tracking systems show tanker movement patterns in near real time. If vessels begin slowing, clustering, or rerouting, markets interpret this as elevated risk. Liquidity conditions also matter. Energy futures markets are highly leveraged environments. Sudden geopolitical risk can trigger margin calls, forcing traders to either increase capital or close positions. This amplifies volatility. For entrepreneurs and executives, the question becomes practical. How exposed is their cost structure to sustained oil above $95 or $100? Manufacturers with thin margins must evaluate whether they can pass increased input costs to customers. Retailers must assess whether consumer demand can absorb higher prices. Logistics firms must renegotiate contracts carefully. Energy-intensive industries such as chemicals, aviation, heavy manufacturing, and shipping are particularly vulnerable. Small and mid-sized businesses often feel these shocks more acutely because they lack large hedging programs. Multinational corporations may lock in fuel contracts months in advance. Smaller firms typically operate closer to spot pricing. Another dimension involves natural gas. A significant portion of global liquefied natural gas exports originates in Qatar, which relies on safe passage through the same strait. Gas price volatility affects electricity markets in Europe and Asia. Electricity costs then influence industrial output. When energy costs rise across oil and gas simultaneously, economic growth projections often decline. Investment models must then factor slower GDP expansion against higher inflation, a combination that complicates policy responses. The strait variable therefore acts as a multiplier. It multiplies uncertainty, it multiplies cost pressures, it multiplies volatility across asset classes. The immediate surge in oil prices was not a reaction to confirmed closure. It was a signal that markets are preparing for the possibility of extended tension. In global finance, preparation often begins before disruption. Business leaders watching this escalation must recognize that energy risk is no longer theoretical. It has entered pricing models. And once pricing models change, strategic planning must follow. The key question moving forward is not whether energy markets will fluctuate. It is whether the strait remains a pressure point or evolves into a sustained economic constraint. That answer will shape inflation, interest rates, and growth expectations in the months ahead. Defense credibility, capital flight, and the cost of perception. In modern markets, credibility has a price. When missile defense systems are activated across multiple countries within the same hour, investors are not only watching the sky, they are watching performance metrics. Over the past 2 decades, the United States and its regional partners have invested hundreds of billions of dollars into layered defense architecture across the Middle East. Patriot systems, terminal high-altitude area defense platforms, naval interception shields positioned in the Gulf. These systems were designed to create deterrence. Deterrence reduces perceived risk. Reduced risk stabilizes capital. But when interception systems are tested in live conditions, perception becomes measurable. Even if interception rates remain high, the visibility of impact changes psychology. Reports of infrastructure damage, even limited, alter risk calculations. Markets do not require catastrophic failure to reprice exposure. They require uncertainty. Sovereign bond markets respond quickly to uncertainty. When regional instability increases, yields on affected countries' debt can rise. A 25 to 50 basis point move may seem small, but across billions in borrowing, it compounds. Higher yields mean higher refinancing costs. Governments in the region collectively manage trillions in sovereign and quasi-sovereign obligations. Credit default swap spreads, a key measure of sovereign risk insurance, often widen during geopolitical stress. Even a modest widening signals that institutional investors are demanding compensation for higher perceived risk. Currency markets react in parallel. The US dollar typically strengthens during global uncertainty due to its reserve status. However, regional currencies tied to energy exports may experience complex movements. Oil exporting nations can benefit from higher crude prices, yet capital may simultaneously exit equity markets due to instability. This creates divergence. Energy revenues may rise, equity valuations may fall. International investors manage this tension by reallocating capital toward perceived safe havens. Historically, gold, US Treasuries, and certain defensive equities attract inflows during military escalation. Defense sector stocks often outperform in such periods. Increased military activity signals potential procurement cycles. Global defense spending already exceeded $2.2 trillion annually in recent years. Escalation narratives can accelerate budget approvals and long-term contracts. But the deeper variable is duration. Short conflicts produce volatility spikes. Prolonged conflicts reshape capital allocation. Military analysts referenced a potential 7 to 10-day operational window for intensive exchange. For markets, duration determines whether the event remains a temporary shock or transitions into structural repricing. If hostilities de-escalate quickly, capital may return to risk assets. If exchanges persist beyond initial forecasts, institutions begin adjusting long-term exposure. Portfolio managers use scenario modeling. Scenario 1, limited exchange, contained impact, oil stabilizes below $95. Scenario 2, sustained strikes, energy above $100, shipping insurance elevated. Scenario 3, extended regional escalation with infrastructure risk. Each scenario carries different asset allocation outcomes. Another dimension is narrative control. Governments frame military actions through public communication. Competing narratives influence domestic political support and international alliances. Investors assess not only military outcomes, but diplomatic stability. If intelligence assessments appear inconsistent with political justifications, markets incorporate political risk premiums. Political credibility matters because fiscal decisions follow conflict. War financing increases deficits. Deficits increase bond issuance. Increased issuance can pressure yields. In the United States, federal debt already exceeds $30 trillion. Higher interest rates compound debt servicing costs. If geopolitical escalation pushes energy-driven inflation upward, central banks face constraints in lowering rates. This interaction between defense credibility and monetary policy becomes a capital flow variable. Institutional investors allocate trillions through pension funds, sovereign wealth funds, and asset managers. These institutions prioritize stability. When they detect elevated systemic risk, they shift allocations gradually but decisively. Emerging markets tend to experience outflows first. Higher risk assets face redemption pressure. Liquidity can thin in equity and corporate bond markets. For entrepreneurs and business leaders, this translates into tighter financing conditions. If banks perceive rising geopolitical risk, lending standards may tighten. Risk premiums on corporate debt can widen. Companies seeking expansion capital may face higher borrowing costs. Even firms with no direct exposure to the Middle East feel secondary effects through global liquidity cycles. Capital is global. Confidence is interconnected. And when defense systems are tested and geopolitical credibility becomes debated, markets respond beyond the region. A single intercepted missile is tactical. A perceived vulnerability is strategic. Investors are not evaluating battlefield success. They are evaluating systemic resilience. Resilience determines capital stability. Capital stability determines growth capacity. The present escalation has introduced measurable uncertainty into defense credibility, sovereign risk, and duration modeling. Whether this uncertainty compresses or expands depends on how quickly escalation stabilizes. For now, markets are in assessment mode. They are measuring interception rates. They are tracking infrastructure impact. They are pricing duration. And they are preparing for the possibility that perception, not destruction, may carry the larger economic cost. Strategic response. How business leaders navigate escalation risk. For business leaders, geopolitical escalation is not a headline. It is a balance sheet event. When oil prices rise 7 to 10% within hours, when airspace closes over a corridor that handles a significant portion of global aviation transit, and when sovereign risk premiums begin widening, companies must shift from observation to calculation. The first calculation is liquidity. Periods of geopolitical stress historically reduce market liquidity. During previous major conflicts, short-term funding markets tightened within days. Interbank lending spreads widened. Credit availability became more selective. Today, global corporate debt exceeds $90 trillion. Much of that debt was issued during low interest rate cycles. If energy-driven inflation forces central banks to delay rate cuts or maintain tighter policy, refinancing costs increase. A company refinancing $500 million in debt at 6% instead of 4% faces an additional $10 million annually in interest expense. For highly leveraged firms, this is not minor. It directly affects hiring, capital expenditure, and expansion plans. Liquidity runway becomes critical. Financial advisors often recommend maintaining 6 to 12 months of operating cash during stable periods. During geopolitical volatility, conservative firms extend that buffer further. Access to credit lines must be reviewed. Covenant conditions must be reassessed. The second calculation is energy exposure. If oil sustains levels near or above $100 per barrel, transportation-heavy sectors face immediate pressure. Airlines typically hedge a portion of fuel costs, but smaller carriers and logistics companies often operate with partial hedges. For manufacturing firms, energy can represent 5 to 20% of input costs depending on the sector. A 15% increase in energy prices can reduce net margins significantly if pricing power is limited. Businesses must evaluate. Can costs be passed to consumers? Are supply contracts fixed or variable? Are alternative suppliers available? Supply chain resilience becomes the third calculation. The Gulf region connects Europe, Asia, and Africa. Disruptions in maritime transit increase shipping times and insurance costs. During prior regional tensions, freight rates on certain routes increased by double-digit percentages within weeks. Companies relying on just-in-time inventory models face higher risk. A single delayed shipment can halt production lines. Firms with diversified supplier networks experience less disruption. Data from past global disruptions show that companies with dual sourcing strategies recovered faster than those relying on single-region suppliers. The fourth calculation involves currency exposure. Energy importing countries experience trade balance strain when oil prices rise. This can weaken local currencies. A weaker currency increases the cost of imported goods and foreign-denominated debt. Entrepreneurs operating internationally must assess foreign exchange exposure. A 5 to 10% currency swing can erase thin profit margins in cross-border trade. Hedging instruments exist, but they require planning. Reactive hedging is expensive. The fifth calculation is insurance and operational risk. War risk insurance premiums for shipping can increase several times during regional conflict. Business interruption policies must be reviewed carefully. Many policies exclude acts of war unless explicitly covered. Cyber risk also rises during geopolitical escalation. Historical patterns show increased cyber activity during state-level conflict. Companies must ensure digital infrastructure resilience, especially those operating in finance, logistics, and energy sectors. Beyond operational factors, there is strategic positioning. Periods of volatility often create consolidation opportunities. Larger firms with strong balance sheets acquire distressed competitors at discounted valuations. During previous geopolitical crises, acquisition activity increased in sectors tied to infrastructure, energy, and defense. Defense spending globally already exceeds $2 trillion annually. Escalation can accelerate procurement cycles. Companies linked to logistics, cybersecurity, and energy infrastructure may experience long-term contract growth. However, executives must distinguish between temporary volatility and structural shift. If escalation de-escalates within weeks, markets may normalize. If tensions persist, capital allocation patterns may change for years. One observable metric is capital flight. If sustained outflows emerge from regional equity markets and sovereign bonds, multinational firms may delay investment projects. Foreign direct investment often declines during extended instability. Young entrepreneurs must recognize that uncertainty rewards preparation. Preparation does not mean panic. It means reviewing cash reserves, debt structure, supply diversification, energy exposure, currency hedging, insurance coverage. History shows that businesses which survive geopolitical shocks are not necessarily the largest. They are the most adaptive. They conserve liquidity early. They adjust pricing strategically. They maintain disciplined capital expenditure. In times of escalation, the temptation is to freeze decisions, yet disciplined action based on data, not emotion, separates resilient firms from fragile ones. The current situation presents measurable variables: oil volatility above historical monthly averages, airspace disruptions in a corridor linking 3 continents, rising sovereign risk premiums, potential tightening in global liquidity. These are not abstract developments. They are inputs into financial modeling. For the business community, the central lesson is clear. Geopolitical escalation does not wait for quarterly earnings reports. It moves in minutes. It reprices in hours. It restructures in months. Those who treat it as background noise risk exposure. Those who treat it as a strategic variable build durability. And in an interconnected global economy, durability is the ultimate competitive advantage.